Imagine an institution that can raise your mortgage payment, move the stock market, and create trillions with a keystroke, yet no one votes for it. It promises independence, but politicians cheer or rage when it speaks, and markets panic if it flinches. So who controls central banks? Are they truly independent or quietly captured? This is Dollar's Dance, in which we rig the money with simple stories to reveal the truth. And it's all about money. Because the story of central banking isn't just about interest rates, it's about power. Who sets goals, who sets limits, and who pays when the bill comes due. Start with the myth. Independence sounds like a fortress, technocrats in a marble building, guided by models, insulated from politics. The reality is a moving border. In quiet times, central banks look sovereign. In crises, that border recedes. The forces that tug on it are simple and relentless. The law that creates the bank, the elected officials who can rewrite that law, the markets that can raise borrowing costs in an afternoon, the banks the central bank supervises, and the ideas that live inside the heads of the people in charge. Independence isn't a switch. It's a negotiation, daily, legal, and psychological. Legally, central banks are creatures of their parliaments and constitutions. Their power flows from statutes, what goals they pursue, what tools they may use, who appoints their leaders, how they are funded, and how they can be fired. That legal design matters more than any press conference. Some banks have instrument independence only. Elected leaders set the goal, say 2% inflation, and the bank chooses the interest rate path to get there. Others have goal independence, authority to choose the target itself. Term length and funding matter too. The Federal Reserve's governors, for instance, serve long terms and finance themselves from their own operations, not annual budgets, on purpose to distance them from election cycles. The European Central Bank was built as a fortress, long, non-renewable terms, a single price stability mandate, and no finance minister above it. The Bank of England gained operational independence only in 1997. In design, independence is a choice, and a choice that can be revised. History shows why. In 1694, the Bank of England was created to fund a war with France. Investors gave the Crown money. The Crown gave them a chartered bank. Independence was born from dependence. In the United States, the Federal Reserve was created in 1913 after repeated banking panics. During World War II, the Fed pegged yields to keep the Treasury's borrowing costs low. In 1951, the Treasury-Fed Accord severed that leash, the modern birth of Fed independence. Germany's Bundesbank built a reputation for defending the currency above all else and inspired the ECB. New Zealand pioneered inflation targeting in the late 1980s. Each step toward independence followed a crisis in which the alternative, political control over money, looked worse. But crises cut both ways. After 2008, central banks bought vast quantities of government bonds. In 2020, when the world sprinted for cash, they opened the floodgates again. Lender of last resort became dealer of last resort, buying bonds when the market wouldn't, backstopping money funds, calming repo markets, offering swap lines to foreign central banks. Independence in theory, entanglement in practice. When the pipes burst, the central bank is the only plumber with a wrench big enough. That creates a new dependence. Markets come to expect rescue. The bank becomes captive to its own success. Who, then, are the real contenders for control? First, elected power. Politicians can't set interest rates hour to hour, but they can set the rules of the game. They appoint the governors, they choose the mandates, they can revise the law. That matters. Turkey's central bank cut rates into runaway inflation as political pressure mounted, and the currency paid the price. Argentina's central bank has long been subordinate to fiscal needs, with predictable outcomes. In India, the government's 2016 demonetization, an overnight annulment of banknotes, was not a central bank initiative. It was a political act, implemented with the Reserve Bank's machinery, a reminder that the state's power sits above the technocrats' comfort. Even in stable democracies, the pressure is subtler. Leaders talk about growth, jobs, or fighting inflation, knowing the central bank is listening. Independence isn't immunity, it's a buffer. Second, the bond market. Call them vigilantes if you like. They can't vote in your elections, but they can vote on your borrowing costs, and they can do it before lunch. In 1992, the Bank of England tried to defend a currency peg in the European exchange rate mechanism. Traders attacked. The pound fell. The UK exited the system in a day. In 2011, Italian yields surged as doubts rose over its debt trajectory and euro membership. Governments fell. In 2022, the UK announced an unfunded fiscal package. Gilt yields spiked. Pension funds that had levered their safe bonds started to fail. The Bank of England stepped in with emergency purchases. A technocratic bank committed to tightening bought bonds to stabilize a market. Who controlled whom that week? The answer is clear. The market set an ultimatum. The bank complied to prevent a fire. Third, the banks themselves. Central banks regulate commercial banks and rely on them to transmit policy. That creates a feedback loop. When a large bank wobbles, the central bank hears the call first. The temptation to stabilize the system even if it softens the blow to bank shareholders or management, is strong. This is not a conspiracy, it is structural. The supervisor cares about systemic stability. The regulated care about their own profits. The revolving door between central banks, treasuries, and financial firms, plus a shared technical language and worldview, can lead to regulatory capture, not because of corruption, but because of identification. If you work in a cockpit long enough, you start to think like a pilot. In 2023, when regional banks faced runs and unrealized losses on their bond holdings, the Federal Reserve and Treasury arranged backstops to prevent contagion. Financial stability trumped textbook purity. Independence bent under the weight of the imperative. Keep the system alive. Fourth, ideas. Central banks are staffed by economists, lawyers, and market veterans. Ideas are their operating system. For decades, inflation targeting reigned supreme. The Phillips curve, linking slack to inflation, guided forecasts. DSGE models, the elegant closed world simulators, shaped debates. Then, the 2010s delivered low inflation despite low unemployment. The 2020s delivered high inflation after a shock. Frameworks evolved. Average inflation targeting in the US, more attention to financial stability in Europe, yield curve control in Japan, but intellectual capture remains a risk. When a small tribe agrees on the model, dissenting signals are discounted until they explode. Transitory became a punchline. Ideas control behavior until events rewrite the code. Fifth, fiscal dominance. When debts are small and deficits modest, central banks can raise or cut rates without breaking the budget. When debts are massive, fiscal arithmetic pushes back. Higher interest rates mean higher interest costs for the Treasury. The temptation to keep rates low, to protect the budget, not just the economy, grows. After World War II, advanced economies capped yields and let inflation run, quietly eroding debt. That was deliberate fiscal dominance. In the euro area, the ECB must manage price stability across 19 fiscal authorities with different debt paths. Whatever it takes, save the euro, but only after a political commitment from governments. The central bank's independence depends on a credible fiscal partner. When that partner falters, the bank either finances the gap, losing independence, or refuses, triggering crisis. Either way, the boundary between money and politics blurs. Sixth, geopolitics. The Federal Reserve is, by accident and design, the world's central bank. Dollar funding runs through foreign banks and offshore markets. Global trade invoices in dollars. Institutions borrow in dollars to buy non-dollar assets. In 2008 and 2020, the Fed extended swap lines to selected central banks, granting them access to dollars in exchange for their currencies. That choice, who gets lines, who doesn't, shapes global finance and politics. The ECB and the Bank of Japan operate inside strategic alliances and legal constraints that reflect national priorities. Even legally independent banks are situated within states pursuing goals beyond inflation. Energy security, industrial policy, sanctions. Independence exists within a geopolitical frame. Seventh, the plumbing itself. In 2019, the U.S. repo market, a vital dollar funding pipe, spiked overnight. The Fed stepped in with daily operations and later installed a standing facility to lend cash against good collateral at a known rate. In March 2020, Treasury markets buckled. The Fed bought at scale to restore liquidity, not just to change the economic outlook. In Japan, the Bank of Japan pins long-term yields near targets to preserve market function and policy goals, accepting balance sheet expansion as the price. In the UK, the BOE bought long bonds to stabilize pension funds before resuming hikes days later. These are not textbook interest rate tweaks. They are interventions in market structure. When the pipes clog, policy follows the plumbers. Independence is limited by the capacity of the pipes to carry policy. Now, flip the coin. Why does independence matter at all? Because money is a trust contract. If people believe politicians will juice the economy before elections and let inflation run afterward, the currency's promise erodes. Independence is a commitment device, a way for a democracy to bind itself to a rule it can break in the heat of the moment. That credibility lowers borrowing costs for everyone and prevents the inflationary whipsaw of political cycles. Paul Volcker's Fed, under intense pressure in the early 1980s, held rates high to break inflation. Independence bought pain up front to buy stability later. The Bundesbank's rigidity, often criticized, anchored expectations that the ECB inherited. Where central banks are arms of the Treasury, inflation and currency crises are common. Independence is not elitism. It is a technology for time travel, promising future restraint in a present that wants relief. But independence is not a blank check. Central banks are unelected and powerful. Their actions have distributional effects. Quantitative easing raises asset prices. Tightening cools labor markets. Backstopping markets protect some balance sheets and not others. That invites the charge of technocracy without consent. The legitimate answer is accountability, not subordination. Clear mandates defined by elected lawmakers, transparent decisions, published minutes and models, regular testimony, and, crucially, humility about what monetary policy can and cannot do. Independence without accountability is arrogance. Accountability without independence is inflation. So who controls central banks? In law, the answer is simple. The people, through their representatives who write the mandate and appoint the stewards. In practice, control is distributed and contingent. The law controls the charter. Ministers control the leadership. Markets control the price of time. Banks control the channels. Ideas control the choices. Crises control the calendar. Geopolitics controls the perimeter. The central bank stands at the intersection and tries to make the light stay green. Consider a few scenes. Black Wednesday 1992, the Bank of England burns reserves defending a peg as speculators attack. Politics demanded credibility. Markets demanded math. Math won. Independence meant recognizing the constraint, not overriding it. The Euro crisis, 2012, Mario Draghi says, whatever it takes, unveiling a program to buy sovereign bonds, conditional on reforms. Independence flexed, but with political strings. The ECB asserted control to prevent disintegration, then tied itself to fiscal commitments it could not enforce alone. Japan, 2016 onward. The BOJ pins the 10-year yield near zero to escape deflation, accepting a massive balance sheet. Independence is expansive here, choosing an unorthodox instrument for a stubborn problem. But the trap is clear. The bigger the footprint, the harder the exit. UK 2022, a fiscal announcement knocks gilts off a cliff. Pension strategies, designed for stability, implode. The BOE reverses course, buys bonds for days to restore function, then resumes tightening. Independence in the target, captured by the reality of market plumbing. United States 2021-2023. Inflation accelerates. The Fed, after calling it transitory, pivots and hikes at the fastest pace in decades. Markets wobble. Some banks fail. Backstops are deployed. The bank threads a needle between price stability and financial stability. Independent in goal, constrained by collateral damage. When you ask who controls, you're really asking what constrains. In normal times, it's the mandate, the 2% target, the employment goal, the rules printed in law. In stressed times, it's the bond market and the solvency math of the sovereign. In panics, it's the obligation to prevent a collapse. Across decades, it's the ideas about inflation, expectations, and the balance between austerity and stimulus that guide brave or timid hands. There's also a quiet form of capture, mission creep. After crises, central banks rarely go back to the old toolbox. They add new mandates, climate risk assessments, inequality research, digital currency exploration, macroprudential regulation. Some of this is sensible. Risks that threaten the financial system belong in the conversation. Some of it reflects the political vacuum. When lawmakers cannot or will not act, the central bank becomes the only functioning policy shop in town. The danger is obvious. The more you do, the more you're expected to do. The more you're expected to do, the less independent you become. So what should citizens watch to tell independence from capture? Watch who sets the goal. If politicians set the target and change it when it's inconvenient, capture is creeping. If the bank sets the goal without a legal basis, that's technocracy exceeding its license. Watch who pays the bills. A central bank that must ask Parliament for its operating budget is more vulnerable than one that funds itself. Watch the appointments. Rapid turnover, political litmus tests, or threats of dismissal signal weakened autonomy. Long, staggered terms and difficult removal make it harder to bully a bank. Watch the plumbing. If the bank spends more time fixing broken markets than setting policy, the constraint isn't political. It's structural. That still limits independence. Watch the exits. Anyone can cut rates and buy bonds. Leaving the emergency is the test. If politics or markets forbid normalization, independence was a wartime story. Watch the words. When a central bank starts talking about topics it cannot control, wages, by decree, energy prices, geopolitics, it may be narrating politics rather than practicing policy. And watch your own expectations. A culture that demands painless growth and instant rescue will capture its central bank by mood. Independence requires a public willing to accept short-term pain for long-term stability. If we vote for comfort today and someone else's problem tomorrow, we make capture inevitable. There's a final paradox. Markets often claim they want independent central banks. What they really want is a central bank independently committed to protecting markets. Politicians claim they want independent central banks. What some of them really want is a bank independently committed to their priorities. Citizens claim they want independent central banks. What we really want is inflation control without recessions, financial stability without bailouts, and growth without risk. Those bundles rarely come together. Someone must choose. Independence is a promise to make those choices by rule, not by whim. Capture is what happens when an emergency or an ambition rewrites the rule in the moment. So who controls central banks? In law, the legislature. In practice, the triangle of ministers, markets, and models. In crisis, the fire itself. Independence is a peacetime luxury and a wartime necessity, the backbone that lets a currency survive politics, and the flexibility that lets a system survive panic. Central banks are independent enough to take the blame and captured enough to take the call. If this reframed how you see the quiet power that prices your future, subscribe. History has the answers. I'll show you where to look.